All right, today on The Explainer, we are diving into something that's set to completely rewrite the rules of Wall Street. We're talking about quantum computing and how it's about to change the very definition of speed in financial markets. For decades, the big race in finance has been all about the speed of light, right? How fast can you get information zipping through those fiber optic cables? But here's the thing, that race, it's pretty much over. We're hitting the physical limits. So the real advantage? It's no longer about who gets the data first by a few microseconds. Nope, it's about something else, something completely different. The whole conversation is shifting. I mean, think about it. We're moving from a simple sprint down a straight road, that's network latency, to trying to solve a massively complex maze. So the new race, it's not about transmission speed anymore. It's about computation. It's about who can find the center of that maze faster than anyone else. Okay, so if the bottleneck isn't the network cable anymore, then where is it? Where's the holdup? Well, the bottleneck is right here, in the brain of the whole operation. We're talking about pricing incredibly complex derivatives or optimizing these huge portfolios with thousands of variables. I mean, these are computational problems so massive, they make even our most powerful supercomputers sweat. This is the new front line. This is where the real competitive edge is being forged today.
And this computational wall is exactly where quantum computing comes into the picture. And look, it's not just offering a faster version of what we already have. No. It offers a totally, fundamentally different way of solving these kinds of problems. So instead of a classical computer's bit, which can only be a 0 or a 1, a quantum computer uses something called a qubit. Now, because of these wild quantum properties like superposition, a qubit can be a 0, a 1, or, get this, both at the same time.
What does that mean? It means a quantum computer can explore this huge landscape of potential solutions all at once, instead of having to check them one by one. And this new way of computing gives us a whole new toolkit, specifically for finance's biggest headaches. For instance, you've got methods like quantum Monte Carlo that can run millions of risk scenarios at the same time, or quantum optimization algorithms that can find the single best portfolio mix out of literally countless possibilities. It's like having a custom-built set of keys for finance's most difficult locks. It's a perfect fit. But okay, how is this stuff actually being used right now? Because we're not talking about ripping out every desktop on a trading floor and replacing it with a quantum computer, not at all. The reality is actually way more practical and, honestly, pretty smart. The winning strategy today? It's a hybrid approach. You use the quantum processors for the really heavy lifting, the super computationally intense parts of a problem, and then you feed their results, their insights, back into the existing classical trading systems that are already running the live market operations. So let's walk through what this actually looks like. Imagine a bond trading desk. They've got a really complex pricing problem. So, step 1, they send that problem to a quantum processor for some offline analysis. Step 2, the quantum system runs these vast simulations. And then, step 3, it spits out a single powerful insight. In this case, a super accurate probability of whether a trade will go through. And finally, that one little piece of insight gets passed back to the classical system to make the final real-time decision. It's the best of those worlds. And look, this isn't just a theory on a whiteboard. As Reuters reported, the financial giant HSBC and IBM recently put this exact hybrid model to the test. This was a real-world trial for bond trading. And the results from this trial, honestly, they were staggering. The hybrid system showed a 34% improvement in predicting whether a trade would successfully execute compared to the old classical methods. Now, to put that into perspective for you, in a market where firms fight tooth and nail for fractions of a percent, a 34% leap in decision quality, well, that's a seismic shift. That's a game changer. Right. So a performance jump like that doesn't just improve one bank's bottom line for the quarter, it signals a fundamental structural shift in the entire market. It creates a brand new kind of asymmetry. And you know what? We've seen this movie before. Back in the 90s, the advantage was being physically located right next to the exchange servers. In the 2010s, it was all about microwave data links. Today, it's having the best machine learning infrastructure. So quantum access, it's simply the next layer of that structural advantage. And it's arguably the most powerful one yet. And this creates a whole new map of winners and losers. You see power starting to concentrate around those who have access to the hardware and the talent. We're talking the top-tier banks, the big cloud providers like IBM, and even sovereign research hubs. And that leaves mid-tier firms and, yeah, even regulators playing a frantic game of catch-up. It really challenges that whole idea of a level playing field. The industry is already voting with its wallet. I mean, just look at the numbers. The market for quantum computing and finance is projected to just explode, growing over 20 times by 2032. This isn't some distant academic exercise anymore. The investment pressure to get ahead is absolutely immense, and it is happening right now. But, as always, with this kind of incredible new power comes a whole new class of risks. And the tricky part is, these challenges are probably going to show up a lot sooner than widespread quantum-powered trading does. So what's the first thing to break? What's the most immediate threat? Well, it's probably not what you think. The first real pressure point won't be on those high-frequency trading loops. Nope. It's going to be on the very systems that are supposed to ensure market integrity and security. And these risks demand our attention, like right now. First up is this cryptographic time bomb that people call harvest now, decrypt later. The idea is that bad actors could be stealing and storing encrypted financial data today, just waiting, knowing that in a few years, a powerful enough quantum computer will give them the master key to unlock it all. And beyond that, you have these huge governance questions. I mean, how do you audit a decision made inside a quantum black box? And how can regulators possibly hope to keep pace with all this? So, what's the big takeaway from all of this? What's the bottom line? It's that the very definition of market speed, the central idea that has organized modern finance for decades, has changed. For good. The decisive edge is no longer about who gets the information first. It's about who can process uncertainty faster. Advantage is now going to compound through better answers arriving earlier. And that's going to fundamentally reshape the entire market structure. This isn't just a new tool. It's like we've discovered new physics for the market. And the real question that leaves us with is, who's going to master these new physics first?